So if a real estate agent cannot explain what going on in a transaction, is it a disadvantage or an advantage to the agent?
Well, it is a disadvantage because it adds more stress to the buyers.
Exactly. Nó như ngồi cái ghế này như. So most of the time, thank you so much, Alex. From my point of view, what I see, a lot of time my client, they keep asking questions. It's not because they're giving us a hard time. It's just because they want to know what is their mortgage payment, because they don't know what they are entering into, right? I am buying a home the first time. How much I pay every month? Can I do that? Is that okay if I do that? I mean, but in order for them to find out if they can do what they are doing, they have to know exactly how much they pay. Because they don't want to get into that, it surprised them later. Nobody want that kind of surprise, right? Surprise that I have to pay too much at the end, that's not a fun surprise. And if we cannot answer that questions, those questions keep coming back. And if we never be able to answer or satisfy the client's questions, what happened? They feel like they're not taken care of, right?
Not only that, they walk away sometimes.
Most of the time, not sometimes. Yvonne, can you sit over here? Because I'm gonna pick on you, so sit over here.
I'll pick back. I'm good at picking back.
Okay. Okay. Let's do that then. Okay. So today, I hope that you're gonna take your note and pay attention to what I said, and do ask questions, because I might go over something that I think everybody understand, but then if you don't, I want you to stop me. Okay? All right. So the mortgage points and costs. So we talk about points and costs most of the time, and in the loan transaction, there are two things we want to talk about: points and costs. Because a lot of time people do refinance, they say, I want to do no points, no cost loan. What does it mean, right? At the end, you'll be able to answer what that means. Okay? How much? So the question is, the main question is, how much do I pay for my mortgage application? So we're gonna answer this question: how much do I pay for my mortgage application? I remember I bought my first home in 2000. Of course, I bought the home with my husband. That's our first home. And I remember when I signed a stack of documents at the final loan documents, I was lost because I didn't know what I signed into. I didn't know how much I paid. I didn't know what are those numbers. I didn't understand anything. It was scary. Because when you're not knowing what you're doing, you should be scared, right? I wished I could understand all the numbers. I wished that I could understand why I had to pay that amount to whom. I did not know. Therefore, I created this class so that everybody would understand what they signed into, why they had to pay, and who they paid to. Okay, because there are so many numbers. Okay. So the next slide gonna be, where did it go? Here. Okay, here. Here. Magic. Okay, good.
It'll work tomorrow.
Okay, it works.
It worked from here.
Okay. Okay, this is the first one, I think. This is the. All right. All right, we're going to do the. So we will go over loan estimate, closing disclosures, settlement statement, all kinds of important documents, and we will go over very detailed in each document. I'm not sure if we have enough time to go over all of it, but we'll try, okay? But do ask questions. We don't need to rush. So what is LE? LE stands for loan estimate. LE is a 3-page forms, and you will receive the loan estimate within 3 days. Within 3 days after lender receive your loan application. Okay. So the moment the lender receive your loan application, they issue what called loan estimate. People might ask, lender issue the loan estimate or the loan broker issue the loan estimate? Most of the time, we allow the lender to issue the loan estimate. Okay. So what is in the loan estimate? It have estimated interest rate, estimated monthly payment, and it have it show all the points and closing costs. Why is an estimated numbers at this point? Because you just submitted a loan application. So at this point, the loan is not locked yet. That's why everything is estimated. Monthly payment depend on the rates, correct? Mm-hmm. And because the rates is not locked, estimated rate will you estimated monthly payment. Okay. The purpose of the loan estimate is to provide a consumer a uniform document that is easy to compare the lender's offer from one lender's offer to the other lender offer. So that's it. That's the purpose of loan estimate. How does it look? It looks like this. It has 3 pages, right? And this is the first page. If you look, can you see it? What do you see? Read it from the very top, everything, don't leave out anything. So the very first thing you see, Funding Corp, it's a lender name, right? Funding Corporation. And then, I can't even read. And then you see underneath there's a name and loan estimate, and there you see date issue, applicant, all kind of thing, and property address and the sales price. What is the sale price over there? You
440.
see? 440,000. 440,000. And on the other side of the top part, there's a loan term. What is the loan term?
30 years.
30-year fix. And is it the purpose of the loan is?
Purchase.
It's a purchase transaction. What is the product?
Fixed rate.
Fixed interest rate, right? They want loan type. What is the loan type?
Conventional.
So you can read it, okay? And the loan ID in the loan number. So each loan have a loan number, right? Does this loan lock yet? The rate lock yet?
No.
Not yet. See, most of the time when people receive the LE, the rate is not locked yet. But sometimes we lock the rate at the beginning. So you have to look at it locked or not locked.
Are you testing our eyesight?
Yeah, we kind of. So what is the loan amount? Because we're gonna teach you how to read. When you do loans, you will learn how to read every single thing that come to your sign, because that loan processor does. A good loan processor, the bad loan processor, an outstanding processor. The difference is the one who read most. The one who care most is the outstanding one. The one who doesn't care, who doesn't read, just receive and forward, that's a really poor, terrible loan processor. They don't know what they're sending to the lender. And that will kill the transaction 1,000 times. So the loan processor, a good one, actually the outstanding one, will read every single document that come to her before she have to look at it to see, should I turn this into my lender or not? Okay? So loan amount is 330. In this case, what is the estimated interest rate?
4.875.
4.875. Okay. Monthly mortgage, monthly principal and interest payment is $1,746. That's an estimated based on the interest rate of 4.7875. Okay. Prepayment penalty, yes. Okay. This loan is the no doc loans. Okay. So, and this loan, it's have a 3-year prepayment penalty.
What's all the no next to the monthly principal and interest rate?
Oh,
No.
no.
Loan amount
I
and the right
suppose-
says no amount. Maybe it's not applicable?
I forgot what it is. Good question. I will look into it. It's supposed to have something, some description on the top, but it doesn't show. Okay, I will look into why it's no. Okay, but good questions. Balloon payment is a no. You know what balloon payment is, right? And nowadays there's no balloon payment. And then the protected payment, you see there, principal and interest. There is no mortgage insurance. There is no escrow. There is no escrow. That means they don't want to pay tax and insurance with the monthly mortgage, so it doesn't show it there. Okay, and down there you will see estimated tax and insurance. Tax means property tax and insurance monthly payment. So no escrow. You see in escrow, no, that means no impound account. So you kind of go through this one really quickly. Underneath we have estimated closing costs and estimated cash to close. Your client will look at that two number only. And they wait a minute, why I have to pay this amount money? You're like, why I have to bring in $14,885? That is their client, their question most of the time. In order for you to answer that question, you have to be able to go to page number 2 and understand every number on page number 2. So most of the time, I will go straight to page number 2 to explain to my client. They will say, no, I want to know what is $14,885. I said, I will get to it as when you understand what it is in page number 2, because page number 2 is the breakdown. But I would at this point right now, I just wanted to show you what it is. So you see there are two sides of the page 2. One is, what is it on one side? Loan costs, right? And the other side, what is that? All the fees, right? All the costs? Okay, all the costs. So the loan cost, there are 3 sections, and the other costs, there are many sections, okay? We will go over it line by line. We will break it down. Very soon we will get into it, okay? And this is the last page that most of the time we don't go to this page, because this page is more like a summary of the first 2 pages, and it's really confusing. If you try to explain this to your client, they will be really, really confused. The best way to not confuse people is not to talk about something confusing, right? So go to the next one, please. So in order for me to explain everything on page number 2, that's the most important area where you want to work with your client, we have to understand every single number on that page. So before we go into explaining the numbers, we have to know what are mortgage points. Okay, there are 2 mortgage points. The first one is the origination points, and the other one is the discount mortgage points. The origination points are used to pay to the lender for their overhead and administrative work. And the discount mortgage points are used to pay to lower the interest rate, to lower the interest rate. The borrower want lower interest rate, they pay for the discount point, okay? All right, get it, right? No question, right? That's just a definition. Here you go. I remember we have 2 sides of the page 2 of the loan estimate. Now we go into the loan cost side, right? If you look, what is the origination points? You see? Do you see it though? Do you see it there? Yes. What is the number? Read it to me, Jackie. The origination point.
5,775.
But do you see that in the loan cost? You see the loan cost image I show there? Do you see it there? Do you find the 5,775?
Right on the top.
Right on the top.
Yes.
You all find it, right? People on the Zoom, do you find the 5775? Alex, can you read me? Can you see it, Alex? Can
Yeah,
you
right
see?
there on the top. The
But
first
can you read the wording?
percentage of loan amount.
No. Okay. Okay. Good thing. The percentage of loan amount. If it shows the number, that's the discount points. But in this case, the loan estimate, we haven't locked the rate. Normally, when you have not locked the rate, you don't see the discount point. Okay, you don't see the discount point, but you see the origination fee. Right underneath the percentage of loan amount, you see the origination fee, and that origination fee is $5,775. Okay, and then underneath the origination fee, what is that? Underwriting fee, right? So right now on this slide, the only number we pay attention to is the origination fee. Okay. Remember, the purchase price is $440,000 and the loan amount is $330,000. So this amount is a 1.75% of $330,000. Okay, so that's the one. We're gonna go to the next slide because this one we talk about the underwriting fee. What is the underwriting fee? Underwriting fee is used to pay the lender to cover the overhead and administrative costs. And in this case, you see the underwriting fee on the image, on the closing, on the loan costs. It's shown right there. So in the first section, we're gonna call it A. If you add the discount point and the origination point and the underwriting fee, it will be A. Okay, why I'm gonna give you A, B, and C? Because at the end we're gonna do the calculation. So the section that have close points and underwriting fee, we add them up, we call it A. Okay, so now that's the section. We go to the next one. Now we talk about closing costs, all the closing costs, right? You see the closing cost including the origination charges in section A. Now we have B and C. I supposed to name, I just name them. You want to name them? So you have three sections in the image, right? You see it. So the first section is A, the second section is B, and the last one is C. So so A is all the number add up, and B is all the number add up. Like when you add B, you add appraisal fee, you add with credit report fee and flood certification fee and tax service fee. You have a total number, that's a B. And then the C is when you add all the title fees together, that you have the C. So A is the total of the first section, B is the total number of the second section, and C is the total number of the last section. Remember this because this is important for the next slide, okay? So those are the loan costs. So people who do real estate, who buy a property and they want a mortgage, those are the fee they pay for their loan costs. Okay, so now you know, oh, this is my loan cost. This is how much I pay for my loan. But this is an estimated because it's from the loan estimate. Okay, so now we go to the other side of page 2. It's all the costs. We also break them into sections. Okay, we will give each section a letter name. Okay, so in the other fees we have recording fee, transfer tax, initial escrow payment at closing, owner title policy. Okay, you don't know what is recording fee, right? Recording fee is the fee you pay to the county. So when we buy a home, at the very end, when we get the house, the seller transfer their name to our name. Now we become the owner. The seller no longer become the owner. Then this had to be recorded in the county where we live. And in order to do that, we have to pay the county the fee. That's the recording fee. What is the transfer tax? When the seller transferred the property to us, he had to pay transfer tax, and we also had to pay transfer tax. So both buyer and seller had to pay transfer tax. We kind of split the amount went in the county of Santa Clara. Other counties, some county make the seller pay all the transfer tax. Some county make the buyer pay all transfer tax. But for the county of Santa Clara, we pay half. Seller pay 50%, buyer pays 50%. Initial escrow payment at closing. Good. Okay, I need to stop. So go ahead. Ask your question.
Okay. My understanding about transfer taxes, there are like documentary taxes and accounting taxes. So I do explain that to the buyers because in some negotiation we can negotiate who pays the transfer taxes.
Oh, I don't know about that.
Yeah,
But there are two different transfer tax. One is a county transfer tax. One
And
is a
the
city
city.
transfer tax. That's all I know. Negotiation between seller and buyer, who pay who.
Yeah.
Oh, okay. I think everything is negotiable, right?
Yeah, everything is negotiable.
Okay.
Yeah.
Minh Châu,
Yes.
can I
Yes.
give some information?
Yes.
In Santa Clara, county transfer tax customary is paid by the seller in a purchase transaction. So normally it would be paid by seller. In say example Alameda County, it's paid by the buyer.
Thank you.
Yeah, just to clarify that. But refinance of course it's different. So
Refinance there's only one person that the borrower is the owner.
yeah.
So
But in Santa Clara, it's seller to pay county transfer tax, and there's another tax is city transfer tax, and city is split between buyer and seller.
So, City of Santa Clara, the seller pay for the county transfer tax. The city transfer tax is split by buyer and seller.
That's right. That's
Awesome.
right. Thank you.
Thank you so much. Awesome information. I appreciate it. It's actually show in your statement as well. Okay. But thank you, Ji. Thank you for that information. So, initial escrow payment and closing. This is if somebody want an impound account. That means somebody want to pay property tax and insurance together with their monthly mortgage because they don't want to remember to pay the property tax twice a year and the insurance once a year. They're afraid they forget, so they put that payment together. And when they decide to do that, we have to create what called impound account or escrow account, and that impound account, escrow account is there to collect their property tax and insurance in advance. So what the lender does, they receive those money every month from the borrower. They keep it in that account. They wait until the day the tax due. They pay to the county for the property tax, or wait until the day the insurance due. They pay for the insurance company. And when we create the initial escrow payment account, the client will have to bring in advance money. Why we bring in advance money? We'll talk about that in another section because it's kind of complicated. If we rush it, I'll confuse everybody more. Okay, owner title policy. This is the it's only there when it is the sale transaction. In the refinance transaction, there's no owner title policy. Okay. All right. Do we want to talk a little bit about owner title policy? Anyone? Or you want to just go forward?
Just the cost.
Let's
Let's focus on the cost.
Okay, just focus on the cost. Okay, so let's make it easier.
Yeah.
Okay, so what are the other fees, not closing costs? Okay, so in this, okay, these are not loan costs. We call it other cost, not loan costs, because even someone who buy a home paying all cash, she still had to pay for the recording fees, all this fee, no matter what, even though they buy all cash. So that's other costs. Okay.
Also,
They pay some title and escrow fee too.
yeah. Also, we normally explain to the buyers what are the recurring closing costs and non-recurring closing costs. Ones that they pay only once, and the other ones every month.
Awesome. Okay, you bring that up. So I like talk about recurring closing costs and non-recurring closing costs. Non-recurring closing costs are the costs that pay one time. Non-recurring, that means all the loan costs are non-recurring, and even the recording fee and transfer tax is non-recurrent. But the recurring closing costs are actually the insurance, the mortgage, those. But yeah, that's the thing. Thank you for bringing that up. Okay, so I will just introduce to you that. Let's go to this one. See, now I will add up the number. You see, I assign each section a number. So section A, I will add all the number in there. You see? And section B, I add all the number in there. And C, and look at D at the bottom. D is the total loan cost. It includes A, B, and C. Do you see it, everyone? Is it easy to follow? And D is $11,096, right? And on the other cost side, I also assign letter names to each section. So E is the total of that section, F, and then G, and then H. In this section, in the G section here, because the client doesn't want impact account, so it's 0 there, right? H is the owner title policy because this is a purchase transaction. Remember that? And also when the purchase transaction, we also see the transfer tax. And I section is the section, the total order cost. So I equal to E plus F plus G plus H. You see that? And the total amount of I is $3,789. Is it easy to follow, everyone? Do you understand all the number now? And J equal to D plus I. Where is D? What is D? D is the loan cost. So now D is the loan cost. So J is D plus I. So now we add the loan cost to the other costs. So we have the total amount that the client had to bring in at cash to close. I mean, it's a closing cost for the. Do you remember the first page of the loan estimate? It showed this number, $14,885. Can you now? Are you able to explain this to your client? It's easy, right? You have to just read them all. So let's go to the next page. We are now going to the CD. Okay, CD stands for closing disclosure. The CD provides details about mortgage that you are applying for. The CD is more like it's more. Now the CD will have the final payment and the final interest rate. Most of the time the CD go out only after you lock your interest rate. Every time you lock your interest rate, there is a CD. Okay? That's why it have the final payment. If the buyer or the borrower doesn't change any more loan amount or doesn't change anything, then it should be the final number, unless they say, oh, I want to change the interest rate or I want to change the loan amount, then that's not the final payment. But if there is no change then that should be the final number. Okay? CD includes loan terms, protected monthly payment, how much you will pay in fee and other costs to get your mortgage. Lender is required to give you the CD at least 3 business days before you close on the mortgage loan. This 3-day windows allow you time to compare your final terms and costs to those estimated in the loan estimate that you previously received, and to ask any question before you sign your final loan documents. So your client or the borrowers will receive a CD 3 days before they sign their final loan docs. Why we have the 3 days? We give the borrower a chance to ask questions about all the number. And most of the time, it is the time when you sit down and explain to your client what's going on with their fee, their payment, their interest rate. This is the time. I do that every time before my clients sign, so that when they sign the document, they feel confident. They know what they sign into. This is what our job. We make them feel, I know what I'm doing. I didn't have that agent. I didn't have anyone who tell me what I pay for, how much, why. I didn't have that agent. I felt scared, lost, and wished that I understand all of it. Don't let your client be in position where I had, because that is not a good feeling, right?
I don't think you're the only one. Because way back when, I know a lot of agents just kind of flash through it because they don't want you to question. They don't want you to understand every single numbers.
Thank you
because you
for-
may question.
It's very good. Thank you so much.
It happened to me. Many
That's
times.
why you see on Facebook now, you see this type of thing post almost every day. That's why I created this course, because I don't want this to happen anymore. People got scared and they post this on Facebook. It's terrible.
What did they post?
Facebook, they keep asking, do I pay too much? That's the question. When you don't know, you will ask that question, do I pay too much? Right? So don't do that to your client.
What I normally receive is that what are the breakdowns of this amount? So I know that they can afford to pay it. They just want to know the breakdown, and we're pretty much the LE and the CD pretty much break it down for us.
But a lot of loan agents are not transparent. Either they don't understand it themselves, or they don't want the client to ask too many questions and figure out, oh, how much they're making out of this. But I know even my experience with, even as my friend, she did it for me. I bought an investment and she charged me a point and I didn't even know. I just went ahead and signed because I assume it's going to be no point, no fee. She knows that previous loans I've done with her is no point, no fees. But with the investment, she charged me a point she didn't tell me. So when I signed, I just trust her. And then later on, I went in and worked with her, and I look every single day. I go, shoot! I would look back in my paperwork. I go, I got charged a point. How come you didn't tell me? So even friends do that to you. Not understand, they don't.
So it happened
They
a lot.
just want you to sign quickly.
It's happened a lot. I remember when I bought my investment property, that's the second property that we bought. Same thing happened to, what happened to you happened to me. It's not a friend. She just one of the agent, and on the phone she said she don't pay, charge me anything or whatever it is she said, but it turned out she charged me a point. And I was angry because that's my second property, so I kind of know a little bit, not a lot, because I don't have an agent who explained to me everything again. So I was really angry. I talked to the real estate agent who referred that loan agent to me. I said, she told me that she won't charge me anything, and now she charged me 1 point. It's okay to charge people, but you have to tell them in advance, because we don't do things for free.
Right.
But we have to tell people, okay, I charged you 1 point, or I charged you 1.5 points, or
if
2 points.
If she tells me that I charge you a point and your rate is lower, or if you don't want any points, any fees, then your rate is going to be this much higher, then you pick. Then I come in knowing what I'm doing, or knowing my choices. Right. They just go and do it, and then you happy-go-lucky. You trust them before. That's how they did it for you before, and now it's different. When you find out, the trust is gone.
See,
It's their
We don't-
cost. It's her loss.
That
yes.
hurts so much. I think it's like a friendship is a lot more than 1%. It's just insane to
But
lose
it's
a
her
friend
loss.
like that.
Because now you know people.
Yeah.
Right.
So do your job as a agent. You want to be very careful when it comes to money. You want to explain everything to your client so that they feel confidence and they trust you more. When you talk about money, clearly people trust you more.
But the trust is very important in business.
Exactly. That's the most
Yes.
important thing.
Yes.
People only do real estate
goes a
with
long
us.
way.
Yes, when they trust us. This is all about trust, because this involves so much money, right?
Yeah.
Okay. So that's a good one to share. I appreciate that. So you won't receive a CD when you do reverse mortgage. Instead, the reverse mortgage will receive a HUD and the truth in lending. That's the things long ago. Okay. Okay. So we talk about closing disclosure. The format is really similar to the loan estimate. Do you see that? Only difference is instead of loan estimate, it say closing disclosure. But the more important thing is now what the interest rate right now.
Much lower.
A lot lower, 4.375. So whenever we disclose, we try to disclose a high interest rate. Why? We want it to be conservative because the lender will approve the client based on the rate we put in the loan estimate. We rather approve them at a high interest rate and then lock them at the low interest rate, because if we try to put in the low interest rate and then when they have to lock at the high interest rate, the client might not qualify for the mortgage anymore. You see? So when we disclose, we try to use conservative number. We give higher number than they will get later on. The way we did it's very opposite from a lot of people out there. People out there, they give very low number to attract people to be in, and then whatever later they don't care. We don't do that. Of course, we want to calm people down, say, oh, it's not your interest rate. Right now, we just put it in to get you a disclosure, right? But for people that really, really scared, they want to lock the rate right away, then we lock the rate right away, okay? But anyway, this is page number 1. And you see, what is the closing cost at the very bottom? 15,000, right? 15,000 something. Then it's higher than the loan estimate, right? Look, the lower interest rate, higher cost. Does it make sense? So you might think, so do they pay discount point in this case to get the interest rate? They might, because their closing cost is more than in the loan estimate. So you have to take a look, because people said, wait, how come my disclosure so more closing costs than the loan estimate? That's happened, right? Then you will take a look and say, oh, I think let's take a look at page number 2, okay? And then we go to page number 2, and then we go section by section to find out what the difference. This page number 2 of the closing disclosure is looking a little bit different than the loan estimate. Remember, the loan estimate, you have 2 columns. One is loan cost and one is other cost. This one, they have, instead of side by side, it one on top of another. You see that?
And it's bigger prints on the other one.
Yes. So let's go to the next page, because the CD also have 3 pages, and the last page of CD also a summary of the first 2 pages. Okay. Now we go detail into the CD. We do exactly the same thing. I crop them, I put them side by side, just like a loan estimate. Even though they are different, but I just crop them up, I put them side by side. So it looks similar to the loan estimate. And I also name each section a letter. Remember, A is the total number of everything in that section. B is the total number of everything in the section B. And C, so you have A, B, and C, add up together, it's the D. And D, the total loan cost. Do you follow? People on the Zoom, do you follow? I want to hear somebody say yes.
We muted them.
Say yes!
We muted
Yes! People are so quiet.
No, we
Okay.
muted them. They can't say.
Okay, that's okay. It's okay. Okay, so on the other costs, we also give them a letter name. E is the add up, the 2 number, F, and then G, H, and then we have I equal to E plus F plus G plus H. Okay, so you have the total number. So I equal to what? What is total number of I?
All the cost.
Other costs, and what's the number, Lily?
35, 38.
3,500 something.
Yeah, $3,538.35. And now J is equal to D and plus I. Okay, so but we want to know why it's 15,000. Let's go back to the to section A. Look at section A. What the difference in section A, everyone? Look at section A.
Quarter of a point cost.
And I say louder.
I have a 25 increase by the point is 0.25% of the loan amount.
Awesome, and I saw that. So the client paying the discount point of a quarter, 0.25%, to get that low rate, 4.375. So now, before in the loan estimate, there is no discount point and the rate was 4.875. And now she get a 4.375% interest rate, and she paid only a quarter for discount point. So beside the discount point, she paid the origination fee that we disclosed at the beginning, and then the underwriting fee. So now the client is paying more. That's why I think all the other fees stay the same. The only difference is the discount point. Therefore, the total cost is a little bit higher. Instead of 14,000 something, it's 15,000 something. You see? You see the difference? So if you be able to answer this, explain this to your client, will your client be confident signing their documents? They are, right? And can you do that though? My question is now, can you do that? You can, right? This is just so easy. You just need some time to sit down with them. Go over all the numbers. Don't be afraid. Maybe the first time you might feel like it's too much to go over, but you get used to it. Okay?
Yeah, also I think I see the purpose here is that if the buyer knows exactly what the closing costs are, they may be short on funds, so you'll know at that time before we even go to the closing table.
Right. So, and if you are the buyers, if you are the borrower yourself, because you are buying home yourself too, are you happy that you are able to read this by yourself? You don't need anyone to read it for you. You can read it yourself.
Yeah.
Are you happy? Yay! Okay, we should celebrate. Let's go to the next one. Okay. I'm in here. I explain one more thing. What is lender credits? Okay. The lender credits in the loan estimate and in the closing disclosure, normally we should see lender credits, but in both cases we don't see it. You see, I circled the red there. You see that? It's supposed to show that if there is lender credits. Lender credits will only happen when you lock a higher interest rate, and then lender credit you something. In this case, she locked lower interest rate. She doesn't get any lender credit, and she had to pay discount point to get the lender credits. So lender credits and discount point doesn't go together. They don't go together. I give some example right there. And by the way, lender credits we can use, if we have lender credits, we can use the lender credits to pay for our closing costs. Okay? So for example, in this case, 4.375%, she had to pay discount point of a quarter. And at 4.5%, she had to pay no discount point. But at 4.625, she will get lender credits. If she choose 4.625, she might get a quarter lender credits, right? But she didn't. She didn't want the lender credit, so she chose the discount point. So if you see a statement, it have either lender credits or discount point. You don't see two things in one document. Then it's really wrong. Okay? But sometimes I saw that because it's wrong. But it's not on the closing disclosure or the loan estimate, it's on a settlement statement. Okay? You have to, so after you understand closing disclosure, loan estimate, you have to learn how to read the settlement statement. Okay. So this is the frequently asked question. We're going to talk about this a little bit. Do you really save money if you pay for discount points to get lower interest rates? How do we know we benefit or we not benefit? Okay. Go back to the don't go anywhere. To the situation where 4.375% interest rate, a client pay $825. We have to find out if she doesn't pay any point at 4.25%, her monthly payment is $1,672. But for 4.375% interest rate, she pays some discount point, but her monthly payment is $1,648. So it's $24 less. So every month she paid less $24. But in order to do that, you have to pay $825 in advance. Okay, let's see. If you take $825 divided by 24, it's gonna be
34 months.
34 months. It's gonna be 2 years and 9 months.
So it takes her almost 3 years to get even.
It took her 3
To
years
really
and
benefit.
2 years and 9 months to get back her $825.
And then to start benefiting that lower rate.
So after 2 years and 9 months, she will benefit saving $24.
$4 a month.
So if she keep the loan more than 3 years, doing no refinance or selling the home, then she benefit from paying the discount point. If within 3 years, like 2 years after she do this loan, she refinance or she sell the home, she lost. She will lose money. So that when she change the loan within 2 years, it doesn't benefit her. But if she keep the loan a long time, the longer she keep the loan, the more she get benefit from paying the discount point. In this case, she know she have to keep this loan 3 years because if otherwise she have to pay prepayment penalty. So she willing to pay the discount point. That makes sense. If she never had to do, if the rate keep going up, she never need to go and refinance again. She pay 30 years and pay off the loan. She benefits so much from this interest rate. So when we decide to do paying discount point or not, we have to take a look at how long we will get back that discount point, and we have to keep the loan for how long. And it depends on each individual situation. So if someone comes to you and asks you, should I pay discount point? Then you have to ask them back, how long are you willing to keep this loan? Will you refinance this loan within 12 months or 2 years? If they say, yes, I will refinance anytime the rate go down, then do not pay discount point because it won't benefit you. Okay? So the next question is, should I take no point, no cost loan? Same thing. If you will refinance again and again and again every 6 months, then you should do the no point, no cost loan. But if you will keep the loan forever, then you should not do the no point, no cost loan. Instead, pay some discount point to get the lower interest rate so that it benefit you in the long run. But case by case. So you have to use your time, sit down, talk to your client. Based on the situation, what is the best way to go about for their loan? Okay? So one more thing, because a lot of time people do, I do no point, no cost loan. Do I have to pay for appraisal report and credit report fee? Yes. Appraisal report fee and credit report fee, client pay for it all the time. Because those are the fee paid to the third vendor, not to lender, not to us. Okay? The appraisal company is another company that do their own services, and they have to collect their fee. Credit report, we run the credit report through a database. Another company provided that that database. We don't create that database. So their responsibility is paying the appraisal report and credit report fee. Okay. All right. Now we go to another section. What time is it?
11:05.
I think we will stop right here. We will talk about settlement statement next time. It's different from loan estimate. It's different from closing disclosure. But in order to understand the settlement statement, we normally want to understand loan estimate and closing disclosure so that it is easier for us to follow. Okay? Any question before we stop here? No question. Everybody, you can go out and tell everybody, I can read a loan estimate. I can read closing disclosure. I can explain to you every number on the form. I have no problem with reading them. You have to go and tell people that. You have to be like, I am awesome. All right, everyone.
Thank you.
If you have any questions, thank you